I think this is going to be a good year for Bitcoin. I think we started out the year with the ETF approval, and that was a big milestone. I think that the success of the ETFs is another milestone. I think that the halving in April will be a third positive milestone. I think those three things are going to drive momentum, and I think all the marketing wars between the Wall Street firms is going to be positive, and I think the assets being normalized throughout the mainstream investment community, and so I think it'll just keep generating momentum from here. I think it's it's also worthwhile, I think, to make one point. I think that we're living through the Bitcoin gold rush era.
Get ready for the Bitcoin revolution. Michael Saylor, the former CEO of MicroStrategy, is brimming with excitement as he shares his bullish outlook for Bitcoin in the coming year. With ETF approval on the horizon and a tantalizing halving event looming, Saylor sees these developments as fuel for Bitcoin's journey to the mainstream. Brace yourselves for what Saylor dubs the Bitcoin gold rush era, where the finite nature of Bitcoin's supply makes it a hot commodity with a limited window for investment before issuance dwindles post-2035. But hold on tight, because Saylor doesn't just talk the talk, he's all about empowering investors through education. He acknowledges the hurdles facing Bitcoin adoption, from skepticism among mainstream investors to regulatory concerns. However, he passionately advocates for deepening our understanding of Bitcoin's digital capital potential, believing it holds the key to reshaping the financial landscape as we know it. Saylor's message is clear: knowledge is power. He urges everyone to dive into the intricacies of Bitcoin, emphasizing that a thorough grasp of its fundamentals will unveil its unmatched superiority as an asset class. And while he acknowledges the occasional missed opportunity, Saylor encourages a forward-thinking mindset, urging continuous learning and investment in this groundbreaking technology.
I'm not surprised they're successful. I expected them to be very successful. I think there's 10 years of pent-up demand. They're the most eagerly anticipated development in Wall Street. This is like Bitcoin coming public. It's like the IPO of Bitcoin, except it's like 10 companies simultaneously taking Bitcoin public. Because Bitcoin's a commodity. It's not a security. So the idea that BlackRock and Fidelity and Grayscale and Bitwise and ARK, they're all taking Bitcoin public at the same time is a big deal. The fact that I'm not surprised they're successful as ETFs because Bitcoin's the apex ETF. The other ETFs are based on oil, like let's say commodity ones, oil, gold, platinum, silver, palladium, market baskets of commodities, natural gas. All of these things are defective as investment assets because physical commodities aren't scarce. Physical commodities can be manufactured in any amount with additional capital and know-how. So ultimately, the best of them is the gold ETF. But if a bunch of money flows into a commodity ETF, that just actually fuels capital into commodity producers. They just dump that commodity on the market, the price gets held down. So commodity ETFs were never that great an idea. On the other hand, comparing these Bitcoin ETFs to the S&P index, the biggest ETF and maybe the biggest development on Wall Street was the launch of the SPDR, SPY, in 1993, about 30 years ago. And the idea that you could create an ETF that represented a market basket of 500 stocks, that was big. And especially that was big because that came along at a point where people had lost faith in the currency as money, as a savings technology. And so they were trying to figure out what is money. And actually an entire generation of people picked the S&P index as money, right? How are you going to store your excess cash for a decade or longer? Not a checking account, not a savings account, not a bond, but the S&P. So the S&P became money, and that ETF became the monetary index. And that's why today, amongst, that's the most successful ETF. If you look at SPY and all the S&P index type ETFs, they have most of the capital in them. But the problem with those ETFs is that stocks also are not conservative. So if I increase the price of the stock by a factor of 10, you're getting more equity. Or if another way to say it is, if I take hundreds of billions of dollars of cash and I buy the ETF, like S&P ETF, the ETF has to buy all 500 stocks pro rata, which means they're going to have to go buy Tesla and Apple and Google and Meta at any price. They're price insensitive, even if they're overpaying. So when they buy it at any price, what they're doing is they're creating more equity because they're encouraging those companies to issue more stock. And then, of course, this is common sense. If the price of your stock doubles, the employees in the company with stock options, they sell the stock, right? They sell the stock option. When they sell the stock option, you put more stock on the market. So the price creates supply. There's a price supply elasticity there. And that's the same as you have with commodities. It's the same as you have with REITs, real estate investment trusts. And it's the same thing with bond funds. When you have capital flows into all those other asset classes, you create supply of that asset. They're not scarce. Bitcoin's unique because no amount of capital flowing into a Bitcoin ETF is going to create any more Bitcoin.
Michael Saylor radiates confidence when discussing the triumph of Bitcoin ETFs in this segment. He compares their launch to a groundbreaking moment, similar to Bitcoin going public, as multiple companies simultaneously introduce Bitcoin to the public eye. Saylor emphasizes the significance of these ETFs, highlighting their role in democratizing access to Bitcoin and ushering in a new era on Wall Street. By drawing parallels with traditional commodity ETFs and the S&P index, Saylor argues that Bitcoin's scarcity sets it apart. Unlike physical commodities or stocks, Bitcoin's supply cannot be inflated, making it an exceptional investment choice. He delves into the intricacies of ETF fees, emphasizing how lower fees can impact Bitcoin's price appreciation and encourage institutional adoption. Saylor also reflects on the regulatory clarity that comes with the approval of Bitcoin ETFs, signaling a new era of legitimacy for the cryptocurrency. He dismisses concerns about government intervention, pointing to the ETF approval as a concrete endorsement of Bitcoin's status as an asset class. Saylor predicts a ripple effect worldwide, with other countries likely to follow suit and approve Bitcoin ETFs. Despite short-term factors that may affect Bitcoin's price, Saylor urges investors to adopt a long-term perspective. He advocates for a minimum 4-year horizon for responsible investment, foreseeing a positive trajectory for Bitcoin driven by institutional adoption and regulatory clarity. This, in turn, empowers OG Bitcoin holders and accelerates Bitcoin's mainstream adoption.
I think the risk-reward proposition for Bitcoin in the year 2024 is better than any other time in the history of the asset because you have institutional adoption, you have regulatory clarity, you see capital coming into the space, and yet still you can do the survey yourself. Ask 100 of your friends if they're fully invested in Bitcoin and if they understand it. And if 95 say no, right, I would say do your own research. But Bitcoin's 15 years old, so let's look at other great investments. 15 years after Manhattan was founded, was it a good investment? We could start 200 years after Manhattan was founded. In 1776, roll the clock forward, 1791. Was it a good investment? Was real estate in Manhattan in 1791 a good investment? Was it a good investment in 1865 after the Civil War? Was it a good investment in 1970? Was it a good investment 15 years afterwards in, 1995? Was it a good investment in London 20 years ago? 2,000 years after the Romans showed up in London, was it a good investment to buy London property? Right? I mean, these are scarce, desirable properties, right? It's 15 years late is not late, right? The difference between the winners and the losers is the winners buy something valuable and the losers are afraid, right? The losers are afraid to buy the valuable thing because it's too expensive. New York real estate was the most expensive real estate in the United States 300 years late. Right? It's always been the most expensive. Apple Computer was founded, I think, 1976, around then. 15 years after Apple Computer was founded, was it a good investment, right? Check the price of Apple stock in 1993 or 1996. I think in 1998, Michael Dell told the board they should shut it down, give the money back to the shareholders. But the truth is, at many, many points in time, it was a good investment. I think, as I'd said, the real key is to understand what is Bitcoin's use case. It's digital capital. Well, how big is that? $400 trillion? Right? How much capital is locked up in real estate, equity, currency, bonds, collectibles, trophy assets, precious metals in the year 2024? Right? There's probably half the value of most residential real estate is the monetary premium. It's the capital. So, how do you know this? I give you a little test. Go to Miami Beach, go up and down the beach, and then count the number of lights on in a condo building on the beach. Or go to Monaco and count the number of lights on. And what you'll find is that 80 to 90% of all of the condos don't have lights on at night. So people have huge amounts of capital tied up in these idle assets. And there's a lot of reasons for them, but one reason is because they feel like their money is safer there. So in the 20th century, people basically bought sports teams. Ask yourself, what do rich people own when they get rich? They bought sports teams, they bought real estate, they bought companies, they bought land, they bought timber rights, they bought oil rights, they bought gold, they bought, bonds. They just bought stuff. Why? Because they knew if they left their money in the bank, it was going to dwindle away.
Michael Saylor passionately advocates for Bitcoin as the investment of a lifetime, emphasizing its unbeatable risk-reward proposition in 2024. He points out the key factors driving Bitcoin into the mainstream: institutional adoption, regulatory clarity, and a surge of capital flowing into the crypto space. Despite these successes, Saylor reveals a surprising truth. A large portion of the population remains unaware of Bitcoin's transformative potential. Drawing from historical wisdom, he compares Bitcoin's journey to the rise of Manhattan real estate and Apple's stock, highlighting that 15 years is just a fraction in the lifespan of groundbreaking investments. Saylor challenges doubts about Bitcoin's perceived late-stage entry, discussing its role as digital capital in a time of currency instability and regulatory challenges. He emphasizes Bitcoin's superiority over traditional assets, transcending physical ownership and regulatory limitations. Saylor stresses the importance of understanding the economy as a whole and the risks associated with investment decisions. He sees Bitcoin as a solution to vulnerabilities in traditional assets, a digital phoenix emerging from financial uncertainty. Despite his passionate support, he warns against complacency, cautioning investors about the dangers of ignoring risks. Saylor asserts that it's not too late to seize the Bitcoin opportunity, as long as one is open to learning and making informed decisions. He encourages investors to explore the digital frontier, where the rewards of Bitcoin await those willing to leap. What are your insights on Michael Saylor's compelling perspective on Bitcoin's unprecedented potential in 2024? Share your thoughts in the comments below. If you found this discussion enlightening, consider subscribing to our channel for future updates on Bitcoin and other blockchain-related topics. Don't hesitate to give this video a thumbs up if you enjoyed it, and feel free to share it with others who could gain valuable information. Thank you for tuning in, and we'll see you in the next video.